Welcome to On the Call, a service of Zacks Professional Services Division and a live conference call featuring Zacks strategists, providing their analysis of the latest issues and trends affecting investors, the market, and the economy, both globally and here in the U.S. Our Chief Equity Strategist and Economist, John Blank, and Managing Director of Zacks Professional Services, Tim Nyland, will be our panelists today. John is going to lead off with his views on the U.S. markets, the recent FOMC meeting, and interest rates. And then Tim's going to follow up with the value versus growth story. And he's going to answer the question, is the FAANG stock momentum run over? So John, without further ado, get things started for us.
Thanks, Terry. What I want to start out with is the ISM manufacturing comments, and I'm going to give you a little bit of my color on my view on what's been going on here in March and early April with the U.S. markets. The second topic I'm going to go forward with is program trading. I don't think we've talked enough about how the volatility, particularly the last hour of trading in these recent sessions since the correction, what's going on, and I want to address this risk parity idea with everybody because I think I have a credible explanation for what we're seeing day to day, particularly in that last hour. So program trading, my second talk. Third point, I want to get into the Fed and earnings outlooks and give you my thoughts on why I still think info tech and materials are the strategy sectors to be comfortable with going forward for the next 6 to 9 months. So first of all, my view on March and early April markets. What you've always seen, let's skip this stock. You know the China trade story. It's up today. Tomorrow it's down. But the basic point with the China trade moves is this uncertainty and this volatility now has a very clean pattern, which is when the trade deals go south, we get sell-offs and moves to defensives. And when the trade deals move more north, the stock market rallies and the opposite happens. So this uncertainty has, from a day trading perspective, from a program trading perspective, clean exit and entry points. So keep this in mind from a tactical perspective that the China trade has introduced uncertainty, but at the bottom line is it's pretty clear how the uncertainty works. So another thing I want to point out is the Conference Board's index of leading indicators, 8 of the 10 have stayed bullish other than the stock market wobbling around and other than building permits and houses having some issues with probably overpriced housing stocks and higher interest rates. But the bottom line I want to make here is this stock market is not correcting because of fundamentals. There is no question that the leading indicators are tied to the stock market's future performance, and it's almost entirely good. So do stay bullish and do stay with your allocations for a bull market, because it's not clear with all the volatility that you should be paying attention to it other than knowing that tactically there's a lot of ways to arb it and make some money off it. Second thing, let's skip this slide, but the Bank of England and the ECB are out there. You should remind yourself that they are still stimulating the economy regardless of the Fed hikes, that there are, till September, there's QE, and even after September, the ECB will be keeping accommodative low interest rate policy. They still have negative rates, by the way, on deposit. So the bottom line is the Bank of England and the ECB are for sure keeping the 10-year down regardless of what the Fed does. So this year and next year, the one big difference is not actually the Fed hikes. It's that this year we still have QE and the Bank of England in the game making things easy for Europe. So that's the point here. You can read this slide later, but again, the main thing I want to draw your attention, eyeballs to, is that 0, the 0.25 and the -0.4. Those are their policy rates for the various things that are going on. And this is, like they said, the language, extended period of time, and their main concern is inflation, and we haven't seen any of it in Europe. So next thing I want to talk about is this risk parity issue. I pulled these slides together around the FOMC projections and Mr. Powell's conference because I think this is part of risk parity. As interest rates rise now, one of the things we have available to a machine that's logically programmed with code to risk parity, meaning keeping risk minimum, is that you have higher interest rates. 2% annual CD rates are in play now. So you can park cash in at 2%, and the machine will read that higher interest rate more favorably. So one of the is a pull factor, which is that actually the rate hikes are pulling the risk parity machines to move more money out when they play this game. And the higher volatility in the equity markets is being programmed in to push them out. So it's the higher volatility on one side of the program trade and the higher interest rate on the way into the safe haven. Both of those are playing out to create more of these risk parity plays at the end of the day. So first thing to point out, we're definitely on the way to 3 rate hikes in my mind in 2018. There was some talk about 4 hikes in 2019. The bottom line I would tell all of you is that the real issue here is the neutral rate, which is still 2.9%. So if the Fed's at 1.75 and we're going to end this cycle at 2.9, we've got basically 4 before the Fed really decides if they're done hiking. So the bottom line is they're going to overshoot if they're going 3 and 4. They're going to 3, and they may actually pull back to 2.9. But basically between 2.75 and 3 is where this thing ends, which means the real issue for the Fed in terms of they hike too much or too little is around whether that neutral rate is right or not, and we're going to find out next year, not this year. So 19 is the year, spring of 19 is when to start to think these rate hikes could be overdone, not now. So the other thing I want to point out is a little thing, can't see it really well, but what I want to point out is the last hours of many of the days when the market goes down. Today we're way up, so the risk parity machines will see the volatility fall, and they'll enhance the upside today. I would say today, if you think I'm right about this risk parity, you see the markets rally another point into the close in the last hour. It will be very smooth production of that increase because the buyers will move in on an algorithm. But this is my point on down days, and we are not done with down days until this negotiation is over. And I would just think we're waffling, but today, same thing as a day like the day I'm showing, which is that last hour, the inputs to the risk parity machines get programmed in whenever they say, hey, by 1.5 hours before the close, take the VIX inputs, take the CD rate inputs, take the bond rate inputs, take the credit spread inputs, and run our allocations out. That's a kind of a Bridgewater thing that I think is happening with this market. So here's an example of something that's driving these risk parity machines. If we remember how we got into this correction, this thing is all about these volatility ETFs blowing up. Here's one I have is SVXY, there's XIV, there's plenty of these things. They all look the same. And basically what you have to understand is from that 2016 low till that high, that February high, what you did as a day trader using these indexes is you went short these indexes because the volatility was falling on a daily basis. So that added all this liquidity to the market and on one side of the market. So when these blew up, took a lot of liquidity out of the markets on a daily basis. So now we're at 20 on the VIX versus 10 versus last year. So we're going to see more of these big up and down days that just cancel each other out over time because these indicators, these ETFs, are gone, so that liquidity that stabilized the market at lower levels of volatility is gone. So there really is a structural element to the higher volatility, which tells me that you should expect a decay from 20 to 10, the usual decay you see off the VIX, but it might be elevated for longer, for much longer, because this liquidity is gone and these ETFs are over. Another thing I want to point out is here's a slide of the S&P 500 during this correction. I'm going back. You can see that big XIV plunge, and then you can see some of the technical indicators. I got the 50 and the 200 day. So the 200 day is the green line, and you can see what we're doing now with the trying to trade thing is we're basically running off a bull market at the 200 day. So this is what I would expect to hold up until basically June. I think we got 60 days. That's my consensus baseline around the market. But again, the earnings growth rates, which we'll get into at the end of my talk, much stronger than at double digits, 17, 18%. So this is going to create better valuations for stocks now, but there's certainly no rush in my mind. I think we'll get to 200 a day for quite some time. Here's another example of how we got there, and you can see for clearly we're testing it. We're going to move around on it, but we're moving up on it too. Let's go to the next one. One thing that's interesting to talk about is the NASDAQ. Tech stocks are a little different, and I know Tim's going to get into this FAANG thing later. And what you can see in the early part of the correction is that the 50-day was used as support, not resistance, meaning it bounced up off the 50-day a couple times. The China trade thing killed it off because now there's a lot of worries about the chip stocks and retribution from China. But the bottom line is, before that discussion hit the fan, tech stocks were basically outperforming the S&P 500, and I expect when this thing is over, that's the same pattern. So what it gives you a tactical entry point for stocks that you might like in the NASDAQ space for the next month or two, in my mind. Let's go to the next slide. All right, so this is an example of another Trump tweet thing, which is the Amazon thing, tweeting about Amazon. Internally, I've told people before, I have already been advising that the real issue with Amazon is Prime. Prime, when you bundle basically Netflix with UPS, giving free shipping with a $99 annual subscription here with Netflix $11 a month, that's $121. So they price Prime Video at Netflix prices and then give away the shipping. That is a bundle. You can't bundle. So the issue with the Amazon is bundling off the Prime thing. And the way Amazon ran from 200 to 1400 was through bundling. The other thing to know about Jeff Bezos, get online and check this out yourself. He has 29 he's a serial anti-competitive violator. There are 29 infractions in play over the course of Amazon history. This is the biggest one. So I'm not going to go public. This is definitely a ZRS call, private with people like you. But the issue is Amazon Prime is a bundle, and that is anti-competitive. So it's not antitrust, it's anti-competition. And that is the clarification I want everyone to make. The bottom line is Mr. Trump is actually right about this. He's wrong about how he's going about it, but he's right about the call. Okay, let's get into this risk parity thing before we move on to my final thing. But it's clearly the case that big robotic money is moving around the markets at the end of the day. And what I think is, and I hope Tim can give a little commentary on his own thoughts on this, because he's done a lot of work with systemic allocations and indexes that are systemically created. But the bottom line, I think, is that at some point late in the day, the inputs to the equity market, the bond market, the CD market, and everything else between it is input to these risk parity machines. The risk minimum objective is pumped in to and then the allocations are mechanically changed day after day after day. So I bet Bridgewater doesn't make more than 1 or 2% more on the indexes a year, but that's enough to put them into outperformance. And so you shouldn't try this yourself, but it's definitely happening. And the rhythmic thing, the volume-weighted average price, where you see that clear, steady play at the end of the day, that's a machine. That's what I think. So again, it's number 1 and 2. You've got the higher volatility and the incentive on the NASDAQ to get out of stocks, and you've got the higher interest rates to get into bonds, and that's why I think risk parity is enhancing the daily moves of the stock market, and more than we've seen before, and more than we saw in 2017 for sure. Next one. Again, the other thing to point out is I might be wrong. And basically it's day trading, closing out positions that are successful, one way or the other, long or short at the end of the day. And that might be the other thing, is that with volatility, day traders are much happier in these markets than before. Certainly guys at Zacks who run things like Counter-Strike are much happier, more volatility, they do more day trading, close out at the end of the day. So, final thing, let's get into the Fed. Let's go quickly to my next slide after this one. This is what the Financial Times wrote. The basic thing I want to point out with Mr. Powell is that when I looked at his first press conference and the one we had recently, he's clearly doing the case of playing to the consensus in the FOMC. He's not ready professionally to be aggressive. He is taking the lead of the consensus of the FOMC itself. So we're back to board management and committee management for at least a year or two, not Mr. Powell. He just doesn't step out of the meeting forecast. So let's go to the next one. So what do I see about the forecast that interested me? Probably going to read this slide more than I do, but the basic point of two handles on GDP for 2.7, 2.9 this year, and probably 2.4 as opposed to 2.1 next year, and a 3.8 on the unemployment rate. The only thing I had trouble with is I think we're probably going to much lower on the unemployment rate this year than he thinks. I'm actually comfortable with this inflation. I do not think we're going to see it this year, and I do think that he's putting that 25 basis point hike in 2019, and he may shift it into 18 later this year, but it's basically irrelevant of whether it hits. It's just a tactical move on his part. Bottom line is, pretty comfortable with these things. Two handles on GDP growth, modest 0.1 to 0.3 benefit out of the stimulus. Not a great addition to the GDP growth. So, when we did this last time, back in January, I made that call. Number one risk was trade war this year. Markets catching up with this in March. Now it's the number one worry in the BMA Merrill Lynch surveys. So bottom line is, I wrote this slide because there is a proxy out there for how to judge how this is going, which is the yen. And as long as people pour money into the yen, you can think that from the currency traders, which is the smart money on this international stuff, they're worried about what's going on here. And as a Japanese trader and an international carry trader that's making these calls, it's a great way to pay attention to this. So we go to 102 on the yen, you can assume that China's winning this trade war. If we go to 110, 108, or even on a day like today, I'm sure that people are pulling out of the safe havens, you can assume the U.S. is getting a better deal. Bottom line is pay attention to the yen on this trade war thing. So I'll finish up and hand it off to Tim. Follow the March ISM comments, people. This is a great service to get for free. You just go ISM manufacturing, particularly with this tariff and trade on aluminum, steel, now all these Chinese industrial manufacturing goods. The March ISMs are a great place to get commentary that's specific to what's going on with companies and stocks that you own. So I'll finish up with that and hand it off to Tim. Quickly, let's go through my main slides on growth. I like Infotech. Go to the next slide. I particularly like all of Infotech, but I like hardware best. There you can see the double digits on semis and the hardware and the peripherals and the storage and internet software services. You still want to be with tech no matter what. And let's go to the next one. And I do not like value. Tim will get into this, but I don't think the momentum stocks are done, and I think the growth stocks are on. And it's just, but I don't think until June you're going to see any of this actually happen. But I don't think you should interpret that as a rotation of value. That's it for me. I'll let Tim take it over from here.
All right. Hey, John, I just wanted to clarify one thing. Having said everything that you talked about, for you, is the bull story still intact, or are the cracks beginning to show?
Bull story is intact.
Okay. Tim, growth and value, two fundamental approaches to investing that have been debated for a long time. What's the latest on it? Is it still just about competing investing styles?
Yeah, I think it's probably a little bit more than that in today's economy and today's market. So just really quickly, just to comment on the risk parity theme. It's definitely real. It's definitely driving the trends that we're seeing in the market today. Everyone needs to be very aware of it, and also realize that unless you are a professional day trader, and what I mean by that is that a lot of the incoming news is actually being fed and read by machines, and trades are being executed, automatically off of that. It's a very, very difficult trade to actually make reliably. So from an advisor perspective and from an asset management perspective, speaking from old school mandates, stick with your allocations. I'm in a complete agreement with John on this. The bull market's definitely not over. And with regard specifically to growth and value, we've got some really interesting scenarios playing out that we're going to take a look at right now. What we're going to do is we're going to drill down and look at some of the examples of the valuation disparity that's currently at play right now between growth and value. Maybe you've heard a little bit about this in the media. I don't think that you realize the extremes that we're looking at right now, but that doesn't necessarily mean that we're going to mean revert anytime soon. So using the Zacks research system, I've created several slides here that we're going to look at. We're going to dive into the equal weighted S&P 500 value and growth composites. And I really like looking at the equal weighted proxies whenever I'm trying to look at any sort of trends like this, because I like stripping out the cap biases, in a sense defanging FAANG and other mega caps that have significantly outperformed as of late. This is a great way to do it so that it's not biasing your indicators. So what we're looking at here is a 10-year relative PEF12M. Again, we're going to take a look at several classic value indicators relative to growth. So what, again, we're looking at is a 10-year low of 0.76 value relative to growth. And what I do is I just literally subtract that from 1 to determine that value is trading at literally a 24% discount to growth when the median is only a 17% discount. So hit the next slide. Next, we'll take a look at relative price to book. And you can see over on the left that recession period. We've got a 10-year chart up here, so we're going to actually be able to incorporate the tail end of the recession into this analysis. This is a complete post-recession observation, which is very important to realize. And again, the trend is similar, probably even more so exacerbated on the negative trend side. Again, a 10-year relative low point of 0.47 this time relative to growth. Subtracting that from 1 tells us that value is literally trading at a 53% discount to growth, where the median is a 41% discount. So you want to definitely keep your eyes on this value to growth story, because the value stocks are getting just cheaper and cheaper and cheaper. And we're going to look into this a little bit more. Let's go to the next slide. This is the relative price to sales. Again, we are at our 10-year relative low of 0.49 value relative to growth. Subtracting that from 1, value is trading at a 51% discount. The median is a 46% discount. All these stats are at the very bottom of the slide, so you can see the high, the low, the median, the current. It's very, very easy to do this analysis on your own. The very last and probably one of the more important metrics here we're going to look at is dividend yield. So let's hit the next slide. And this one is rather shocking. We are sitting at a 10-year high of a 74% yield premium value over growth. The median is a 35% yield premium. So again, looking at that median 1.35%, current 1.74, we're literally just dividing the two series. That's a huge, huge premium. So when we go to the next slide, we're going to take a look at the real magnitude. And we're going to do this by looking at the dispersion around the central tendencies. So we're going to be looking at the mean, the median, standard deviation of these series so that you can see, the extent to which this disparity is actually taking place. The 10-year relative PEF12M that we're looking at is trading less than -2 standard deviations away from the mean. That's a significant distance or a significant dispersion from the mean. History would tell us that at some point this is likely to mean revert. So we're going to explore that as well here shortly. Next slide. Is that the next slide? Yeah, it just should be, I believe it should be price to sales. So hit one more forward. Yeah, that's good. Thank you. So the 10-year relative price to sales, hopefully you're seeing a trend here. This, again, is sitting at less than 2 standard deviations from the mean. Next slide. Relative dividend yield. trading at greater than +2 standard deviations from the mean. So we are getting some stretched dispersion here. Next slide. Okay. So are we looking at a mean reversion, right? Our opinion is probably not. And the reason why is that we've got real good growth in earnings in our top sectors, and it's basically outpacing the price appreciation, which is actually suppressing those forward multiples. And the interesting point of this is that it's suppressing the forward multiples to levels that we haven't seen since pre-election. So if the growth story is still intact, we've got a lot of catalysts behind us for another forward multiple expansion because of the fact that equity risk premium has risen so substantially over the past several months. Let's hit the next slide. Let's take a look at some of these leadership sectors. So specifically, a few of the EPS growth leadership sectors that John Blank pointed out. Probably one of my favorites is going to be the S&P 500 info tech sector. And again, I defanged this by equal weighting it so that it doesn't look like simply a forward multiple of the culmination of Amazon, Google, and the likes of FAANG. So what you're going to see here is that regarding the equal weighted S&P 500 IT sector, that we are actually sitting lower than pre-elections on a forward multiple basis, 22 pre-election versus 20.5 multiple currently, okay? This is very, very important because basically FAANG has more or less taken down the multiples for the rest of the IT sector, and that's evidenced by the equal weighted results we're looking at. So next slide. Another one of John Blank's favorite sectors is materials, okay? So again, what we're looking at is that green line there. That is the forward multiple for the equal weighted average stock in the S&P 500 materials sector at pre-election. And you can see the current point looks like it's about 17.18, is actually sitting below where we were pre-election. So basically that's telling us that we've got earnings growth that's more or less outpacing price appreciation or that forward multiple contraction. Okay, so we're sitting at 17x, and we're roughly at 17x. So we're literally at election levels there. Next slide. Energy sector. Okay. Obviously, I'm missing my green line. I don't know what happened to it, but you can see a faint blue line there. Pre-election forward multiple levels were 53. We're currently sitting at a 20 handle on the forward multiple, significantly lower. So this is where we're looking at tremendous earnings growth, and we've basically got forward multiples compressing. Next slide, even healthcare is approaching pre-election levels. And these are your growth sectors. So when we talk about, the momentum trade, we talk about growth versus value, we talk about FAANG. I'm going to say it again, that equity risk premium has risen steadily over the past several months. And when the equity risk premium does decline on the back of macroeconomic and political headwinds abating, these PE multiples will again expand and growth will continue to outpace value. So do we have any suspicion that we might get a rotation into value? I would say definitely not. And certainly the FAANG momentum stock run, I don't think is over at this point. I think if anything, what we've done is we've literally just reloaded, and we're just waiting now for the macroeconomic headwinds and some of the political headwinds to abate, and we'll probably see another leg up after that. And these charts should hopefully give you some confidence as to that scenario playing out here. And again, I think that John's time frame around midsummer sounds about right. We definitely need to get some clarity on China policy and some other things squared away, but that's what I'm seeing here, Terry.
All right, Tim, thanks, and thanks to John. Unfortunately, that's all the time we have for this call, but again, thanks to our panelists, John Blank and Tim Nyland. We hope you found this informative. If you have any questions regarding our services, feel free to email them to zrs@zacks.com. If you would like copies of John's or Tim's PowerPoint presentations featured in today's call, again, the email address is zrs@zacks.com. You can contact your ZRS representative directly for them as well, or you can access them in the GoToWebinar console. In the meantime, thanks for joining us. Feedback always welcome from our audience. In fact, after you close out of this webinar, you'll be prompted to fill out a 1-minute survey. We would appreciate it if you would take some time, fill it out. We're going to use those comments to see if we can't improve on the quality and the content of future calls. And as always, we'll look forward to the next time we're all together on the call.